Hello everybody, this is Hanna-Lena Back and welcome to Investor webinar. Today our main topic of the discussion will be bonds, and to make it very brief, our main agenda today will be go through what are investor bonds. They are a new product for us and we've had one round so far and another one currently open, and I will firstly start off by going through what bonds are and how does the investor Crowdbond product work. And after that, we have Teemu Nuutinen from Icon Real Estate and Real Estate Funds, and he will be presenting Icon's current bond offering that we have currently available on the platform. Before I begin, just one reminder to all the participants today. On the right-hand side of your webinar window, you see a webinar panel, which allows you to send through any questions you may have throughout the webinar. So please take that opportunity and send through your questions. We see them here at the organizing end, and then we will be reading those out loud and giving answers to them as well as we go along. So let's get started. Crowd bonds. So what they are. So what are bonds, and especially crowd bonds that we are offering? So as Investor has started, we have been focusing on equity offerings and doing new equity share issues for growth companies of different sizes. But bonds are now a new addition to our service offering to our target client, to our target companies. And it's a new product and it's a debt product, which means that investors loan money to a target company at a fixed interest rate. So instead of actually owning shares of the company, an investor actually becomes a bond holder of the company. The bonds that we offer in our service are unsecured bonds, meaning that the debt does not need to be secured with actual assets, which is different from, for example, if you consider that company would be taking a loan from the bank, which usually require quite many securities to collateralize the loan. Crowd bonds are fully transferable, so they can be traded on an aftermarket, and then whoever is the holder of the bond can then receive the interest that that bond is then paying out to its holder. We have two types of bonds that we are offering. We have so-called crowd bonds, which are very standardized bonds, and they are meant for companies that fulfill the crowd bond criteria. But we also have companies that may be also offering bonds to our service with slightly different conditions, and those we have as well. So that's good to keep in mind when you are going through our bond offering and looking at the offerings, that some of them are actual crowd bonds and others are bond products. So what does it mean then in practice? What is a bond and how does it really work in practice if you're investing in a bond? The company defines the amount of money they are looking to loan from investors, and they also define a duration for the bond. The interest payments are made every 6 months, and the loan itself is paid back at the end of the loan period. The duration of the bond or the maturity can range anywhere from between 6 months to 6 years, and the company decides that as they obviously start the round. The value of each bond is €100, and the minimum subscription in each of our rounds is €500, so 5 bonds, and that is always the standard, the way they are set up. The interest rate is determined during the round itself. And this is probably one of the biggest differences that you probably experience compared to many other kinds of bonds that you may see offered elsewhere in other services and in other channels, is that for investors' bonds, the interest rate is determined dynamically with an auction mechanism that takes place when the offering is open on the platform. And in the next slide, I will going to show you a sort of illustration of what that really looks like and what does it mean. So the interest rate is determined in a way that as an investor, when you're making an investment and you decide to invest in the bond, obviously you first go through the material that the company has provided. They tell their story, go through their business model, and introduce a team, and also tell why they are raising the loan and what are they intend to do with the money. And obviously there are also the important attachments to the pitch, which also give you a view of their financial situation, financial forecasts, and also the rating alpha document of the company's credit rating currently. Once you've then made a decision to actually invest in the company, you click on the invest button on the website, and then you get to this view that you see here. And then on the left-hand side, it says your offer. And this is meant then for you as an investor to say, okay, how many bonds do I want to purchase? Which is here the other field that you fill in. And as you said, as I said previously, the price per bond is 100 euros. So if you choose, like in this example, you take 5 bonds, then the total investment will be 500 euros. So you select the amount of money you are willing to invest, and then you also select the interest rate that you as an investor would like to receive the interest rate you would like to receive on a biannually basis from the company. And then as you put those numbers in, you will see on the right-hand side, which then has the table with all the offers that have come in from different investors. And then you will see your own bid, and you can see where that sort of sits in the overall bidding table. And then here on the right-hand side, where you see all the offers are basically grouped by the interest rate offered. So for instance, here in the example, you might see that, okay, with 6.9%, there are 1,300 euros have been invested, but it might actually come from several investors, not just necessarily one person. But that gives you an idea of where am I currently sitting with my own bid, and how many bids does the company already have with a lower interest rate or with a higher interest rate. The way it then works at the end of the round is that at the end of the round, the company looks at all the offers that have come in and the interest rates that the investors have offered, and they can then select how much money do they actually want to take out as a loan for them. And that finally then determines the actual interest rate that all of the investors of that round will be getting as payment, as interest payments on an annual basis, or every 6 months, sorry. So if the company, for instance, in this example would say, okay, we are actually the maximum loan amount in this example is 200,000 euros. So actually the company might say, well, we can actually make do with a little less than the 200,000 euros. So we're going to be only taking slightly less amount of money, and then we are able to get the loan with, say, 7.8% interest rate or with 6%, depending on what the company decides. So actually for the investors, the final interest rate is not determined until all the bids have come in, the round has closed, and then the company has made their decision on the actual amount of money that they will be taking as a loan. And that will then be the final interest rate, which is then paid out to all the investors on every 6 months. And the feedback we've received so far on this is actually that quite a few investors have found this a quite fun way of looking at this. And also in the last days of the round, there are typically quite a lot of things happening. And obviously investors, once they've made a bid once, they also get a notification if they are in a way dropped out of the round. So if you bid, let's say in this example, there would have been an investor who says, I give you 10,000 euros, but I want 9.5% interest. So if there have been more bids that have come in at a lower interest rate than that one person who has bid 9.2%, then they would actually fall out of the round totally. And then they will receive a notification to say, if you still want to join this bond and if you still want to invest, you need to bid something a bit lower. So in the very last days and the last hours of the round, quite a lot of things may still happen with the bond offering. Then maybe a few words about from a company perspective. So why would companies choose to use crowd bonds as an option for them? And here we just played out very simplistically few differences from a company perspective as to why would they issue equity, Why would they go for a crowd bond, or why would they go for a bank loan? And obviously for us, we clearly see that the company is interested in bonds, and we expect to see quite a big change in the kind of companies that use crowd bonds. So they are obviously more suitable for more established companies, because obviously from an investor perspective, the thing that matters most is really the company's ability to pay back the interest rate of the bond on a regular basis, and they need to have a very solid business and solid story to back that up as well. So clearly bonds are meant for, not for the seed stage early stage growth companies, but clearly companies that already have a profitable existing business ongoing, and they are able to then use bonds as one of the options on their financing. One of the discussions we've had with companies with regards to whether to go for bonds or what's the relationship between a bond and a bank loan is obviously that bank loans obviously typically are a lot cheaper from the company perspective in terms of the interest needing to be paid. But obviously from a company perspective, they require securities from the company side, and entrepreneurs' personal issues are involved as well, and also many times banks may have very strict covenants for the companies or different milestones that they need to meet, and that makes bonds quite attractive for many entrepreneurs as well. So that sort of gives you a bit of the idea of the kind of thinking or the thinking process behind companies choosing to use crowd bonds as an option for their financing. And one final thing before I let Teemu take over and introduce Icon's case to all of you are the criteria for crowd bonds. And the guidelines for crowd bonds on the investor service are very strict. So the companies issuing crowd bonds need to have 500,000 euros on revenue, so 500,000 in revenues, and they need to be making a positive net profit. But as said, so far the cases we've had on the bond side, they have been slightly different. So if there are companies that don't meet these criteria exactly, then there might be other ways we can potentially negotiate a bond round for that particular company. And the same goes for Icon real estate bonds as well, which are in a very particular kind of industry, and the reasons then there are slightly different. I'd like to stop here and now give the floor to Teemu so that Teemu can take over and go through the Icon bond case. Just going to check whether there are any questions that have come out at this stage, and if not, then we're going to move on to Teemu's section. There is one question which is that can companies from all kinds of industries raise bond financing? And the answer is yes. We don't have any industry-specific rules or any guidelines on that. Obviously, there might be differences in terms of the way the business logic works for a particular industry, and some industries might be more suitable than others for bonds, and investors might be more used to seeing bonds in some type of industries. But from our side, we don't have rules that would say that some industries are not really accepted or can be used. And now we move on to Teemu and Icon Real Estate. And then if you have any other questions with regards to the overall Invesdor Bond or then the Icon, just keep sending those through and we will answer those at the end as well. But now I will give the floor to Teemu.